Hi, everyone. Welcome to the webinar today. I am so glad to have you with us. My name is Alexandra Alvarado, the Director of Marketing and Education at the American Apartment Owners Association. So as you all know, 1031 exchanges have been a very hot topic lately in the news. We've covered it a little bit previously in some webinars. Today we have 1031 Capital Solutions with us, and they're going to be talking about not just the benefits of 1031 exchanges, but also why they are here to stay. You may have heard that they may be going away. They have a very solid case as to why you may not need to really worry about that. And also, if you do decide to use 1031 exchanges, when would it be a good time to use it? When is it going to be beneficial for you? How do you use that as your preferred tax strategy? Rick and Jason have both done several webinars for us. Rick has his JD and a background in law as well as finance, and Jason has his MBA. They're going to be introducing themselves, talking a little bit more detail on that. And just want to let you know that the full recording is going to be available tomorrow. I will send everyone the recording tomorrow. There really won't be any slides today. This is going to be more of an interactive discussion. And so we won't have slides for that, but I'll definitely share Rick and Jason's information with you, as well as some of their resources on their website that are very helpful. And we'll have some Q&A at the end. So this should be roughly about an hour, and I hope you stick with us this whole time. We are very glad to have you, and I will put this over to Jason to start, and he'll take it away from there. So thank you so much, guys, for coming on to the call again.
Thank you.
Our pleasure. Yeah, thank you very much for having us on. Appreciate it. So before I get into the meat of the presentation, let me just take a moment to introduce myself and my partner, Richard Gann, and our company. 1031 Capital Solutions specializes in helping folks that are doing 1031 exchanges to find passive replacement options. So the company offers access to a list of vetted DST properties, and we'll go into that a little bit. We also offer a lot of education material, which you can find on our website, and a lot of advice in terms of how to pick the right properties based on your given situation. My partner, Rick Gann, he has 9 years experience as an estate planning and real estate tax attorney. He's held an executive position at a number of the country's leading real estate investment companies, and he heads our office up in beautiful Lake Oswego, just outside of Portland. As for myself, I have 23 years experience in financial services. About the last half of that, 12, 13 years, has been dedicated to securitized real estate investments, primarily for 1031 exchange investors. Rick and I co-wrote a book, How to Retire from Being a Landlord. For joining us today, we'd be more than happy to send you a free copy of that book. We have a digital version that we can email to you, or if you prefer a paperback, we will send that out to you. You just email us at the end of this. I believe it's info@1031capitalsolutions.com. If you email us at that email address, we'll put that in the mail for you or send it out to you. For today's agenda, what we're going to talk about, we're going to kick it off by going over the basics of 1031 exchange. Our assumption is that most of you are already pretty familiar with what 1031 exchanges are, but since we're going to talk about the threat to removing them and why we think that's not a threat, it really helps to understand what 1031 exchange is and what it does. So we'll take just a moment to talk about that. We're going to talk about some of the proposals on the table and how they've evolved in terms of eliminating or altering 1031 exchange. And we're going to talk about the main reasons that we're personally not worried about that. With a company whose name is 1031 Capital Solutions, you can bet we're dialed into what's going on and what those proposals are. And we think we have some pretty good reasons why 1031 exchanges are going to be here for a long time to come. And then we're going to talk about what if we're wrong. So if we're wrong and 1031 exchange does go away, how can you plan for that? What are the best moves to make in that type of environment? So first, what is a 1031 exchange? Well, before you talk about 1031 exchange, you have to talk about what it's like not to have 1031 exchange. So if you have a capital asset and you sell it, used to be whether it was real estate, art, collectibles, anything, if you have a capital asset and you sell it, a tax bill is due. Well, 1031 exchange is a way to sell a capital asset and defer the capital gains on that asset. Used to apply to all different types of assets. A couple years ago, the law changed, and now it only applies to real estate. So if you sell real estate that's held for investment or business purposes, and you don't want to pay the capital gains on that asset, you can avoid it by doing Section 1031. A couple rules you have to be aware of. You have to replace that asset with like-kind property, which in the real estate world just means real estate. You can't sell a piece of property and replace it with a stock or a bond or a mutual fund. You have to replace it with real estate. You have to follow certain rules. Before you close escrow on the property, you have to engage a qualified intermediary to act as a secondary escrow account. So the funds will go to your qualified intermediary rather than to you as the investor. And then when you make your replacement property selections, the qualified intermediary will send the funds to the seller. Because the funds never went to you personally, that's the reason you don't have to pay tax on that. You have some timelines that you have to be aware of. You have to purchase your replacement property within 180 days of the day you sold your original property. And if you haven't completed all of your purchases within 45 days of when you sold the property, then you have to ID your property to your exchange accommodator. Now, IDing the property can be somewhat tricky. There's some rules you have to be aware of when you ID the property. There's a few methods that you can use. The first and most common is the 3 property rule. That means if you get to day 45 and you have to ID your property, you can pick any 3 properties in the United States, as long as they're investment properties. And then your menu of options that you're going to choose from is one of those 3 properties. Well, if you want to ID and purchase 4, 5, 6 properties or more, you can do that, but you wouldn't use the 3 property rule. You'd use the 200% rule. The 200% rule says that you can ID as many properties as you want, as long as the total value of those properties is not more than 200% of the value of the property that you sold. And then finally, there's the 95% rule, which says you can ID as many properties as you want, any value that you want, but you have to close on 95% of the value of the property that you acquired. So those are sort of the highlights of 1031 exchange, so that we understand kind of what they're talking about doing away with. And so who are the people that are talking about removing or changing the 1031 exchange rules? Well, as Rick's going to get into, it's important to note that there's no populist movement. There's no groundswell out there to get rid of 1031 exchange. It was really a political platform. And now it's in the hands of staffers, most of which are in their 20s, that are putting forward these proposals. And we're very early in the process. So there is no law that's been written yet. It's nowhere near coming to fruition here. And Rick will go into that in a little bit more detail. But some of the changes include, or they originally would get rid of 1031 exchange. That's been changed to limit it. There's other proposals that have to do with changing or eliminating the step-up and basis rules, and other rules that have to do with increasing capital gains. And we put a different sort of odds on each of those changes actually coming to fruition. But again, there's no major push behind this. It's a small number of people that are putting forward proposals. Because the effect of those proposals can be so dramatic, it's getting a lot of attention, but there's not a lot of support for it at this time. So the last thing I want to mention is, as we go through this process, we don't really have a structure where people can just reach out and ask questions. So if you do have questions, how are we doing this? Is there a chat box, or Rick, Alexandra, I don't know if there's a place to put them in, or if we're going to do questions at the end, or how's that going to work?
Yeah, there is a question box at the bottom of your screen to enter in questions. We'd prefer to have you put the questions there so that we don't miss them, but the chat is also open for comments.
Okay, very good. Well, Rick, I'm going to turn it over to you now that I've sort of set the stage in terms of what 1031 exchange is. And why don't you talk to us about the major reasons? I know there's more than 3, but we've sort of identified 3 major reasons that we feel really confident that 1031 is going to be around for a while. So I'll kick it over to you.
Thank you, Jason, and thank you, everybody. And before I start delving into this topic and sort of making our case, as Alexandra said, for why we are confident that 1031s are going to be around for a while, I'd like to have the audience engage with us. We've got a few polls just to sort of to gauge how where all of you are in terms of your ownership and how you're thinking about the properties that you have. And so the first question we have is, how likely are you to sell a rental property this year? Very likely, somewhat likely, or not likely to sell a rental property this year? And one of the reasons we ask this question is so that we can understand, when you jump on a seminar like this, making sure that we're delivering content that's relevant to you, and how likely you are that you are considering selling at least one of the properties that you own as an apartment landlord. And I know some of you have other non-apartment real estate as well. So thank you for engaging in that poll. And it looks like 70% of you are either likely or somewhat likely to sell one of your properties this year. So that's a great indication of kind of where we are. Of course, every call that we get is somebody who is going to sell a rental property. And part of what we do is to help people make an educated decision on whether to keep a property, whether to sell a property, or whether to do a 1031 exchange with their property. And so this whole process of learning and understanding what's going on, not only in the real estate marketplace, but also in the tax marketplace, is critical, because you cannot make an educated decision about whether to buy, hold, sell, trade a property without knowing what's happening in the tax world. So with that, as Jason said, let's jump into what's going on with these proposals. And what you're going to see here is our attempt to be a little bit more interactive with the audience. We have not done this very much, and so rather than have boring slides with bullet points, what I wanted to do is just be a little bit more interactive with all of you in terms of what's on the screen and being and responding to what's going on. And this also gives us the flexibility to be able to make points as the news changes, as things change. And it's been a very dynamic environment. And if I put together a presentation a month ago on this topic, it would look different than it does today. So the first reason that we feel confident that 1031 exchanges are going to be around for the foreseeable future is just the history. And the first thing I'm going to note here with regard to history is that 1031 exchanges are not a loophole. And the reason I make that point is, if you've been reading in the news or on blogs, especially from the folks who are proposing to make changes to the tax code, it somehow became a talking point among this group of proponents that Jason referenced to use the term loophole to refer to the 1031 exchange. And that is really silly. Merriam-Webster defines loophole as an absence or something vague in a rule or law that allows a person to avoid punishment. And when we think of a tax loophole, usually what you think of is there's some law firm or CPA firm that has dug into a hastily put together law or regulation and has identified an opportunity to take advantage of unintended consequences of how a law or regulation was drafted. This is not what a 1031 exchange is. The 1031 exchange is a well-established part of not only of our law but our regulations. There have been how many hundreds of cases, how many rulings from the IRS, how many individual regulations have been promulgated, all regarding doing a tax deferred exchange with real estate. So do not let anyone tell you that a 1031 exchange represents a loophole for the rich. This is a well-established part of our tax jurisprudence going back a long time. And in fact, going back a long time brings me to the next thing I'm going to write down, which is 1921. This year, 1031 exchanges celebrate their 100th birthday or 100th anniversary. We have an entire century of people being able to sell a property, acquire a new property, and not have to recognize gain on that transaction. And then, of course, since that time, we've seen the development of exchanges that don't require a swap of properties. Then we had the Starker exchange in the 70s. And then in 1991, we had the Congress created more specific rules. And so today what you have are all the rules that Jason described that are sort of the evolution of this concept that is now 100 years old, and again is a well-established part of the tax laws of this country, and more importantly, as we'll see in a minute, a well-established part of the real estate economy. As part of the history, there are really two rationales that both support the 1031 exchange. One is continuity, and the other is this concept of highest and best use. So let me start with the continuity. More specifically, back 100 years ago, when Congress approved the idea of what became the 1031 exchange, the principle was that if you own property and you are essentially in the business of operating real estate, and then you sell a property and exchange it for another property, you have what's called continuity of enterprise, meaning that you are still in the business of operating your real estate. You've just swapped it out for a different parcel, a different property. And this is different, despite what some pundits will tell you. This is different than selling a stock. Don't let somebody say, well, if you can't do a 1031 exchange when you sell a stock and buy another stock, why should you get to do it with real estate? Well, that's ridiculous, because you are not in the business of running the company whose stock you own, right? You have basically sold a shares of some entity that you have no participation in, no management in, no control of. You are not in the business of owning that stock. You just happen to own the stock or the gold or whatever it is that you sold, or a bond. But with real estate, you are in the business as a landlord of operating real estate. And what Congress decided a long time ago, and has been upheld countless times, is that the idea that if you continue to own investment real estate, that why should you have to have why should you be penalized transactionally with taxes, even if you change out the property that you own, as long as you continue to be in the enterprise of owning and operating real estate. The second rationale for 1031 exchanges is highest and best use, meaning if everybody is immediately taxed, and when I say taxed, I really mean penalized, for selling real estate, then it's just human nature that people are far less likely to actually sell real estate when it should be sold. And people are going to be unable to buy real estate when it should be bought, if in between that buyer and the seller is the threat of the punitive taxes. And because of the unique nature of real estate, meaning that every plot of land is unique, unlike stocks, bonds, mutual funds, dollars, there's a special uniqueness. It's the whole reason why we have an entire body of law dedicated to property. It is important for a developed society to achieve the highest and best use of any parcel of land. And we cannot achieve as a society the highest and best use of any piece of real estate if people are holding on to that real estate and not developing it, not handing it over to someone else who can do something better with it if they can't sell it because they're afraid to get hit with punitive taxes. So these two rationales, one the continuity of enterprise and the other the highest and best use, provide a different rationale for deferring capital gains tax on real estate than you have for stocks, bonds, mutual funds, et cetera. And this is why history is on the side of maintaining this tax policy of not taxing people when they exchange their real estate. All right, the second important reason why we are confident that 1031 exchanges aren't going anywhere has to do with economics. And one thing I'm going to note here is, according to Ernst & Young, 10 to 20% of commercial real estate, CRE, 10 to 20% of all commercial real estate transactions involve a 1031 exchange. Now, think about that for a moment. Of all the hundreds of billions of dollars of real estate that are exchanged every year, they estimate between 10 and 20% of all of those transactions involve a 1031 exchange. Think of how devastating it would be to the real estate economy if 20% of all real estate transactions didn't happen because people didn't want to sell their property because they didn't want to get hit with the taxes. And you know, that's what would happen. I mean, maybe not every transaction. Some people just have to sell. They have no choice. They're going to need to sell. But you know, given the choice of selling a property and paying a punitive tax, a lot of people are just going to decide to, you know, to sit on their property. And this is one of the compelling cases that the industry is making to the folks that are paying attention to this in Washington, D.C. You know, even if you forget history for a minute, let's talk about economics. So that in and of itself is compelling. But someone might say, all right, well, what's the big deal? How does this really affect what's going on out in the real world? What do we really care about? Why do we care about whether these transactions happen or not? And so Ernst & Young did some other dug deeper into the numbers to see what the consequences would be economically of removing 1031 exchanges from our tax code. And so the first thing they did is they looked at how many people are employed either directly or by 1031 users or by suppliers to 1031 users. And they found that 568,000 people are employed either directly or indirectly with companies that are involved in 1031 exchanges. That's a significant number of people whose livelihood depends on the ability to buy and sell real estate under 1031 exchange. The next number is, what is the collective income that's being paid to these folks? And that number is $26.5 billion. $26.5 billion of income to people who are employed either directly or indirectly in the 1031 industry. The economic value of the industry, in other words, what is the contribution of the industry that depends on the 1031 exchange? And that number, again, according to Ernst & Young, is $55.3 billion of value to the economy. And then, you know, of course, the big question that a lot of folks in Washington want to know is, you know, what kind of revenue is generated for the government? You know, always comes down to, you know, if you're a politician, how much money are we getting as the government from all of this activity? And Ernst & Young estimates that between state and federal taxes, that $7.8 billion of taxes go to the government every year as a result of economic activity driven by the 1031 exchange. So I'm just giving you the lightest overview of deep analysis and surveys that are being done by the industry with firms like Ernst & Young that are, you know, they're walking around Washington right now in the corridors and the halls of power, talking to folks to make sure that the handful of kooks who are presenting getting rid of 1031 exchanges are, that, you know, that those voices are overpowered by reason and rationale. And some people care about the history, some people care about the economics. There's compelling reasons why this would be a real mistake economically at the state and local level, beyond just the implications for federal tax revenue. So great economic reasons for why 1031 exchanges should be left alone. And then finally, really the most practical reason why we are not worried, as Jason said, our company is called 1031 Capital Solutions. If anyone should be worried about 1031 exchanges going away, it would be us. But the most compelling reason is politics. We just believe that the political reality of what's happening in Washington is going to quash this notion of some kind of just a minor tweaking of the 1031 exchange, let alone an abolition. So let me explain our thoughts here. And the first thing I'm going to note is NAR, the National Association of Realtors. The National Association of Realtors is the second largest lobbying spender in Washington, D.C., after the U.S. Chamber of Commerce. And you may be surprised to know this, because when you think of special interest groups and lobbying firms, you might have other ideas pop into your head. But actually, the U.S. Chamber of Commerce is just sort of a generic entity. So if you set them aside, then the National Association of Realtors is actually the #1 highest lobbyist organization for a specific group, and that, of course, is the real estate industry. So when you have the #1 lobbying voice in DC being the National Association of Realtors, what that tells you is the industry is funneling a lot of energy, and more specifically, a lot of dollars, towards making sure that that anything that's going to affect the real estate economy is plucked out of whatever omnibus legislation comes out of the current negotiations. And I should also mention that a third of the dollars that the NAR has spent in recent years has gone to Democrats, and now that the Democratic Party holds a majority and then a slim majority, respectively, in the House and Senate, then obviously that proportion will only increase. So we have working on our behalf, and I don't know that everyone on this call is always necessarily aligned with the National Association of Realtors, but I will say this, that as a lobbying group on this issue, they are representing all of us who work in this industry, who work in real estate, who own rental properties. We are all on the same side when it comes to the need to maintain this 100-year-old tax policy. So and NAR is just one example. Then another number I'd like to reference is the range of net worth of the top 50 wealthiest members of Congress. 11 to $214 million of net worth. The top 50 wealthiest senators and representatives, actually this stat goes back to 2018, so this could have changed just a little bit in the last congressional cycle. But the top 50 wealthiest senators and reps have a net worth that ranges from 11 million to 214 million. By the way, the gentleman who is the wealthiest of that whole group is actually a Democrat with the $214 million of net worth. And 18 of those 50 people are Democrats as well. So this, just to dispel this notion that this is, that all this wealth is concentrated on the Republican side of the aisle. And the point of this is to say, look, we've got 535 members of Congress between the House and the Senate, and a tenth of them have a net worth between 11 and $214 million. These are folks who not only do they have considerable wealth, but they have wealth tied in real estate. I've never met in my life a single person with any net worth approaching any of these numbers who didn't have a significant portion of their net worth tied up in real estate. And a lot of these folks not only have net worth in real estate, but they owe their wealth to real estate that they owned or inherited or developed over time. So it's hard to imagine that that members of Congress and members of the Senate would allow a sweeping change of the tax code that would be so detrimental to their own interests. And I guess what I'm saying here is that good old-fashioned self-interest is going to come into play here when we talk about how Congress is going to look at adding a change to 1031 exchanges to a larger legislative package. Another thing that Jason alluded to as well is really what this is all about. This idea that that we would even consider making a change to 1031. I'm sure there are some people that would like to see this happen, but for those of us who talk to the people who are in Washington, who are having real conversations with real staffers and real members, there's a common theme in those conversations, which is that they've basically thrown out to the media, they being the folks who are proposing a whole bunch of different tax changes, really everything possible and seeing what's going to stick. And that people who add 1031 exchange abolition to a list of potential proposals hopefully are not serious that that's really going to happen. But by threatening to make all of these changes to the tax code, it gives them leverage to be able to pull some levers on some parts of the tax code that maybe do not have the same protection and lobbying protection as 1031 exchanges do. For example, I think it's more likely that we could see the estate tax exemption be adjusted as a result of this legislation because the estate tax has been a political football that has been kicked around over my entire career. When I started as an attorney, and Jason will remember this, and some of you I'm sure will remember that that the estate tax exemption was only $600,000 per person, and so now it's north of $11 million, and the number of people today who have to worry about an estate tax is a tiny fraction of the folks who had to worry about the estate tax when I graduated law school. And so I could see that pendulum swinging back and seeing Congress lower that limit back down because that's an area that when it comes to sort of populist politics that you can really go after these go after these themes of taxing the wealthy, and so that's a different political animal than the 1031 portion of the tax code. So that's just an example, one of the areas where we believe that these proposals to make a change to the 1031 tax code are really being done to create some talk and some buzz, so that then they can take that back off the table as sort of a gesture in the negotiations to allow them to make a change somewhere else in the tax code. And honestly, there are no natural anti-1031 folks. this is, if you ask the average person, out on the street, how do you feel about changing Section 1031 of the Internal Revenue Code? Other than landlords, most people would have no idea what you're talking about. And so but if you ask people about, taxing the wealthy when they die, then even people who don't understand an estate tax exemption will voice an opinion on that. So this is not an area that has a natural opposition when it comes to this portion of the tax code. And for that reason, we are confident that the handful of people that have thrown out this idea, are when it comes to it, are not going to have the support that they need to ultimately see a change that becomes part of any legislation. By the way, as of today, despite all the buzz that we've seen in the media and blogs and so forth, and I've seen a lot of webinars on this topic, there is no bill that has anything referencing a change to 1031 in it. This is simply reaction to the Biden administration publicizing nothing more than a legislative proposal. So as of right now, this is just being talked about, but there's not even a bill to vote on or even a bill that's being worked on as of right now, although I'm sure somewhere there's some committee staffers who have a draft of some legislation that references 1031. But there is no specific bill to ask your congressman or congresswoman to vote no on yet. But ultimately, we really don't think this is going to come out of committee anyhow. So that's where we are. And then, as Jason said, what if we're wrong? What if despite our confidence that somehow through the legislative process, something does come out of committee in the House, and then the House passes a large bill where buried on page 700, there's a change to Section 1031 of the Internal Revenue Code, and that gets over to the Senate, and they vote on it, and they with the slimmest majority, and next thing you know, President Biden has signed a bill that affects 1031. What if that happens? And we don't think it will, but we want to address the what ifs. So there's really two versions of that scenario. One is what would happen if the current proposal to have a cap were in place on capital gains that you could defer in a 1031 exchange, and what would happen if 1031 exchanges went away altogether. And for those of you who aren't familiar, in the proposal that the Biden administration publicized, the idea was that 1031 exchanges would continue to happen, but that you could only do a 1031 exchange to the extent that you are deferring up to $500,000 of capital gains. And even now, we don't know if that means per year or per transaction, although per transaction seems to make more sense. But so that is the current proposal. So if you had a $5 million property and you had bought it for $1 million 25 years ago, and you had $4 million of gains, and you would, if you did a 1031 exchange, you could only shelter $500,000 of your gains, and the rest would be taxed. So at that point, the 1031 is not really going to be a material factor in your decision to buy, sell, or hold that property. But for smaller transactions, it could be. So that is as specific as we have seen at this point, which is this a $500,000 limit without any specificity beyond that in the current proposal. And as Jason mentioned, there are still a few people out there beating a drum to abolish 1031s altogether because of the fact that it's, again, supposedly a loophole. So with that, I want to hand things back over to Jason and let him share his thoughts, our collective thoughts on what would happen under these two situations, and how some of the services that we provide could help mitigate either one of these scenarios, if a change in the law were to happen.
Thanks, Rick. Yeah, I'm going to take a pause. Before I get into that, we've had some really good questions that have come in, and I've responded to them in typing, but I wanted to go through some of the questions that we get a lot, because I bet if it was asked by one person, there may be several more that have a similar question. So I'll get through that, and then I'll come back to what you asked me, Rick. The first question is, can you 1031 exchange a second home for other real estate, or does it have to be an investment property? So the 1031 exchange rules require that the property being sold and purchased is held for investment or business purposes only. So that generally means if it's a second home, a vacation home, that it does not apply. Now, you might have an Airbnb or something like that that you use as a rental property, and maybe you visit it once a year, that could apply. But in most circumstances, if it's purely a second home, it's not going to be 1031 exchangeable. Second, is there a penalty if I start a 1031 exchange and I don't purchase my replacement property by the deadlines indicated? There's not a penalty, but you will pay the tax as though you never did a 1031 exchange in the first place. So kind of depending on, if you want to consider the tax a penalty, then yes, but there's nothing in addition. You don't have penalties on top of the tax. Next question, can I 1031 exchange a single family rental into a commercial triple net property? You absolutely can. So the term like-kind property, which is one of the components of a 1031 exchange, really confuses a lot of people. Like-kind simply means real estate for real estate. So you can sell a single family property and exchange it for an office building. You can sell raw land and exchange it for an apartment building. It doesn't matter as long as it's real estate. What you cannot do is sell a piece of land and exchange it for a stock or a mutual fund or a partnership in most cases. But any type of property is usually going to be okay. One person asked, I often hear about DSTs being used as backup properties when doing a traditional 1031 exchange. What percentage of your clients go directly into DSTs? Is that their initial intent versus a backup? We do have a lot of clients that call us because they're about to close escrow on their replacement property, but they're not 100% sure that it's going to go through. And so they'll list a DST as a backup. I would say ballpark 95% of our clients that come to us have DSTs in mind as their primary replacement property. They don't want to manage property anymore. They want to be a passive investor. They want the opportunity for cash flow and appreciation. And so they come to us looking for a DST, but it is also used as a backup property or to cover, if somebody's sold $1 million property and the property that they're going to purchase as a replacement is $900,000, they might invest that remainder, that $100,000 into a DST. So there's a few different ways that you can use the DST. Reading the next one here. Do I need to identify the replacement property prior to purchasing the replacement property? Maybe, maybe not. So if you get 45 days out after you sold your relinquished property and you have not completed purchasing all of your replacement property, then you have to ID your properties, given the 3 methods that I outlined earlier in the presentation. And then you have to select one of those properties on your ID list. But let's say you sold a property yesterday, and a week from today, you purchase your replacement property, whether that's a DST or any other property, and you close next week. You never have to submit an ID letter. So that's really ideal, because ID letters limit your options. And before you get to day 45 and submit that ID letter, your options are virtually unlimited. So in most cases, we advise our clients to invest in their DST properties well before the 45 days, which is usually pretty easy because it takes 3 or 4 days to close a DST property, not 30 or 40 the way it does most traditional properties. Can a 1031 exchange be completed from an apartment building to a single family rental and then rent it out to a family member? Absolutely, you can do that as long as it's a legit rental. So you're charging fair market rent, you have actual rent being collected, you keep track of all of your expenses, and you treat it like a rental the way you would if it were a non-family. There's no problem with renting it out to a family member. Somebody asked where they can get the basic rules of 1031 exchange. They want to review them. These are in our book. So at the end, if you email us at info@1031capitalsolutions.com, we will give you either the digital copy or the paperback, whichever you prefer, and it will go over all the rules related to 1031 exchange. Next one, can you do a 1031 exchange from a piece of property to some sort of a REIT or fund that is real estate, but not something you would need to manage daily as you do when you're a landlord? Yes, that is what a DST is. It is a way to do a 1031 exchange with your proceeds into a form of real estate that is purely passive in nature. And you can also exchange those funds ultimately into a real estate investment trust. Now, this confuses a lot of people because you cannot do a 1031 exchange from a piece of property into a real estate investment trust or a REIT. But there is a two-step process where you 1031 exchange into a DST, then that DST gets absorbed into a REIT, and at the end of the day, instead of a single property, you own shares of a REIT. So you have a broadly diversified portfolio of properties, institutional management, potential for regular income, whether it's monthly or quarterly, depending on the REIT, potential for appreciation, and potential for liquidity because it's in a REIT. So you can trade your property for a DST, or you could trade your property ultimately for a REIT, depending on what your goals are. And we advise clients on the pros and cons of each of those strategies.
Jason, that's a good segue into another element of the DSTs, which is being able to reinvest your equity outside of the state that you're in. Could you talk about the ability to diversify geographically when you invest in DSTs?
Sure, that's a great point. So particularly in places like California and Oregon, where the two of us are, with the recent passages of rent control and other burdensome regulations on landlords, high taxes, not necessarily business-friendly environments, a lot of people would love to sell their property on a tax-deferred basis and then transfer that property somewhere out of state where it's a more business-friendly environment, where the taxes are lower. The challenge, of course, is being an out-of-state landlord. People are very reluctant, for good reason, to own a property in Texas or Florida or Tennessee or Georgia. And one of these places, the economics may be better, the taxes may be better, it may be a significantly better investment, but am I comfortable owning a property that far away? That maybe at best I'm going to go see once or twice a year, and probably not even that. By investing into a DST, you can have the benefits of investing out of state, higher cash flows, lower taxes, better business environments, more friendly to landlords. But because it's through the DST manager is the one that's getting up every day and managing the property, dealing with lawsuits, dealing with COVID and all of the issues that were around that in terms of making the property safe and negotiating with tenants and negotiating with the lenders and doing all of the day-to-day work that makes a property profitable is all done by the DST manager, which is typically a very large, very capable institutional real estate investment company. So it allows people to move their assets out of state and get the benefits of it without the worry that they're going to be an absentee landlord.
Yeah, that's probably a good, place in our presentation here to pause and issue our second poll, which happens to be on this topic that Jason just mentioned, which is gauging your willingness to invest in a 1031 investment outside your area. Of course, subject to the caveats that Jason just mentioned. What we're really asking is, how comfortable are you investing outside of your home neighborhood, knowing that you could take advantage of institutional management and have a DST, for example, that is owning and operating an institutional caliber property of which you have a fractional interest. So we'd love to see how how much you would consider investing outside your area, yes, maybe, or no. Just take a second to answer this poll. While you're doing that, you should be aware that almost all of our clients are on the West Coast, and almost none of our properties are on the West Coast. So Jason and I are in the business of helping people relocate their equity in an easterly direction, primarily for the reasons Jason mentioned, which is business friendliness, taxation, landlord regulations, etc. Again, so we've got, 84% of you at least that would consider investing outside your area. That's great. Thank you. So Jason, if we don't have any more unanswered questions to get caught up earlier.
Well, we do actually, and it kind of leads into the last segment here. And so one of the questions which sort of opened my eyes a little bit, somebody said, what is a DST? So let me take a half a step back and touch on that. So a DST, which is it's the investment vehicle that Rick and I most commonly work in, is a way to own a slice of a large commercial property. So DST stands for Delaware Statutory Trust, and it comes into play when you sell a property and you want to do a 1031 exchange to defer your taxes, but you don't want to go find the property and negotiate the purchase price and arrange financing and close escrow and manage the property yourself and do all the accounting and have the legal liability, and then someday market the property and list it, negotiate it, and pay off the loan and do all those things. So a DST is a way for you to buy in to a percentage, a slice of a large commercial property, where literally all of that is done for you as the investor. So you might have 10 or 15 options to choose from. And so you can look at, different properties in different markets. They might be apartments, they might be self-storage, they could be medical office, they could be an Amazon distribution center. And you as the investor have all the due diligence material at your fingertips to decide whether or not you think that's an appropriate investment for you. And of course, we offer tremendous guidance in that process. That is what 1031 Capital Solutions does. But once you make that investment, you become a passive investor. So you have the potential for monthly cash flow and appreciation. You get all the tax benefits in terms of the write-offs for depreciation and interest expense and all of that. But you're passive, and so you're having somebody else handle all of those things. So that's what a DST is, and that's one of the passive options that you can go into. Rick, do you want me to go through some? We have quite a bit of other questions, or should we get back?
Well, let's tie a bow on how the DSTs tie into what we're talking about on the what if, and then we can come back and answer more questions. So proposing this question, Jason, starting with what if we have a situation where we end up with a cap on each 1031 transaction of $500,000 of capital gains that you can defer. How does what we do, how does a DST help solve for that situation?
Sure. So let me start by saying this cap of 500,000. Let me explain what that is. So one of the proposals, the sort of leading proposal at this point, is to put a cap on the deferral of taxes on an exchange of more than $500,000. And there's a little ambiguity as to whether that means the transaction size or the capital gain. And so we're not really sure how this plays out. But let's just say that the final regulation comes down and they say all transactions over $500,000 are going to get taxed. Well, if you have a $2 million property today and you're contemplating selling that, one of the benefits of DSTs is you can invest relatively small amounts into a DST. So you could take your $4 million and invest it into 4 different DSTs of $500,000 each. And the nature of DSTs is they have their own distinct timeline. Some may sell the property in 4 years or 5 years or 6 years or 7. And so what you have is 4 different properties now that are going to sell at different times, all being below the $500,000 threshold. Or if they creep above, it'll be barely above. So that's one way that if this particular proposal moves forward and they put a cap at 500,000, but you've taken your $2 million property and converted it into 4 $500,000 properties or 5 $400,000 properties, then that's a way to stay below that threshold and not pay taxes even in an environment that changed.
And then let's talk about the scenario that we really don't anticipate happening, but because people keep asking us, I feel obligated to answer. So what's going to happen in the world if this is the last year that you can do a 1031 exchange?
So if you look at the options, so let's look at two scenarios. Let's say you have a property valued at $2 million and you're worried that 1031 exchanges are going to go away. And you say, well, I'm just going to keep my property because I like my property. I know my property. I don't like dealing with the tenants. I don't like paying the mortgage. I don't like all this stuff, but I know what it is and it's good enough and I'm just going to hold on to it. Well, if 1031 exchange does go away, you're basically handcuffed to that property for the rest of your life. It doesn't matter how bad the tenant is. It doesn't matter if the roof is caving in. It doesn't matter if the neighborhood is falling apart. You're keeping that property. Otherwise, you're going to pay a massive tax bill. Well, another option is, I've talked a little bit about DSTs and trading into these REITs. So all these companies that offer DSTs either already have REITs as part of their corporate portfolio, or they're developing them right now. And another option for that person that's worried about 1031 exchanges going away would be to get into some DSTs, because the DSTs are going to have the option of rolling into the REIT. Now, remember, you can't 1031 exchange into a REIT. It's a different section of the tax code called 721. So if they get rid of 1031 and you're in a DST property, you still have the option of 721 to do a tax deferred exchange into a REIT. Now, why would you do that? Well, it's tax deferred. And you now own shares of a broadly diversified REIT that may have 100 or 150 different properties. And that's a place that you can sit there for the rest of your life, because it's not a single property that maybe a tenant or a roof or something is causing you major problems. So you could end up owning shares of the REIT, get your income, get your appreciation for the rest of your life, even if 1031 exchange went away. So a lot of our clients that are most worried about 1031 exchange going away, even though we tell them we're not concerned, they're going into these DSTs with the plan of 721 exchanging those DSTs into a REIT where they can stay the rest of their life and not pay tax.
And then let's touch on, I know we've only have a few minutes left, but let's touch on some of the scaremongering that's gone on, because there are folks out there that are grabbing these headlines on the possibility of a change to 1031s, which, again, I hope we've made the case that is a very slim possibility, but are turning that into a probability and then using that to try to get people to pursue other tax strategies that do not involve a 1031 exchange, particularly the deferred sales trust strategy, and also the qualified opportunity zones, which, again, we've done some of those deals and we think those are appropriate for a limited number of clients in a limited situation. But I'd like to just spend a minute differentiating 1031 exchanges and DSTs with this deferred sales trust strategy.
So yeah, it has gotten a lot of headlines. I would say the biggest things to note about the difference between deferred sales trust and the Delaware statutory trust is, if you decide to go into a deferred sales trust, you're exchanging your property for a stream of income. And that means that once that property is effectively sold, it's not yours anymore. So if you put $1 million into a deferred sales trust in exchange for a stream of income of 5% or 6% or however you structure it, if that property doubles or triples in value over the rest of your life, that is not your asset anymore. You don't get the benefit of that. Your children don't get the benefit of that because you don't own that property anymore. You've sold the property in exchange for a stream of income. So you lose the potential for appreciation. The other thing is that you pay tax So in a 1031 exchange, you defer the tax forever as long as you keep that going until you pass away. In a deferred sales trust, you're paying the tax, you're just paying it 5% per year, 6% per year. So you're just paying it over time. But over the rest of your life, you've paid all of that tax that you could have otherwise gotten rid of. There is no step up in basis right now. If for a deferred sales trust, you have no step up in basis. So those are the big reasons sort of behind the scenes. There's also incredibly high fees and expenses in a deferred sales trust. And what's most interesting is when you sell your property to a deferred sales trust, they sell that property and then they have to buy assets. They have to buy investments that create income for you as the investor. Guess what the number one investment in many deferred sales trusts is? Delaware statutory trusts. They use the exact same thing in the deferred sales trust because it's a great way to generate income for the investor. Now, it's not all deferred sales trusts, but it's very common to lift the hood and look at what a deferred sales trust invested in to generate income. It's a Delaware statutory trust. So the investor could have just done a 1031 exchange directly into a Delaware statutory trust, saved the fees, kept the appreciation potential and the step up in basis.
Yeah, the DSTs represent a multi-billion-dollar industry. We anticipate that over $5 billion of equity, representing over $11 billion of real estate, will go into DSTs this year alone. It's no coincidence that Deferred Sales Trust has the same acronym as DST. It causes a lot of confusion, and I suspect there are a lot of people out there who find their way into a Deferred Sales Trust sales pitch, not realizing what they were originally seeking. And I happen to know that there are folks out there who have been convinced that 1031 exchanges are going away, and so they're disregarding a 100-year-old proven tax strategy for a scheme that doesn't even has not even been recognized by the IRS as viable. So the point of all that is we are confident that 1031 exchanges are going to be around for another 100 years, but wait until you see actual legislation being voted on for anyone on this call before you start making decisions about alternate strategies to 1031 exchanges, because it's just a little premature to go chasing down other ways to defer taxes when you have right in front of you the number one proven strategy for how to defer your capital gains taxes when you sell and buy another property. At this point, we are over our time, yeah. But Alexandra, if it's okay, we'd love to stay on and answer more questions for the folks who are willing to stick around with us.
Yeah, absolutely. I think that would be much appreciated. I know we have 15 open questions still, so Jason, you did a great job of addressing those. I think there were just a couple things here still on DSTs, recommending how they can learn more to start making those kinds of investments. I suppose the best step would be to go to your site. I see here you have some sources on the screen. I can share this with everyone on the email that I'll be sending tomorrow, which will have the recording in it. So don't worry if you missed anything, but I hope you'll stick around at least for a little bit longer, because I'd love to have you and Jason go through some of these remaining questions. I can be here all day, but I also want to be respectful of your time as well. So if you want to just take on a few more, it's open, whenever you'd like to head out. I'm okay with that.
Okay, I've got about 20 minutes and I can stay on to answer these. And then if whatever we don't get to, if people, will we automatically get them that we can follow up with the people that asked them, or should they email us, or what's the best way?
Yes. So if you did go put a question in the Q&A, I'll share those questions with Jason, with you and Rick, so you can follow up with them. And that way, in case we don't get to all of them, they'll be answered no matter what. And then what I'd like to do to just finish off is just to have, both of you on the screen so that we can focus on what you're talking about. So I'm going to go ahead and put this on full screen mode here. And I will also get off screen so that you can handle some of the questions, Jason.
Okay, thank you.
And maybe we can do our last poll before we answer these
Ah,
questions.
yes, I almost forgot the last poll, which is a very good segue. Now that we have the information on the screen, you do want to learn more about 1031 replacement properties and whether, in your specific situation, how that would work. Definitely having a call with Jason or Rick would be the best next step, I would say. So if you say very interested, I'll go ahead and share your info with Rick and Jason. If you say somewhat interested, I'll let them know that you're somewhat interested. If not interested, I won't share your info. So go ahead and answer that. And Jason, if you want to start looking at some questions there that you found interesting, we can start with that.
Sure, I'll try to get through all of them. There's 17 now. So the first question is, what formula do you use to place a value on income property? There are actually multiple methods, sort of like the housing market. You have comps in the area, what did other similar properties sell for, square footage. Probably the most common method is the cash flow method. So you take what the net operating income is and divide it by the market cap rate and come up with a value there. Usually multiple methods are combined together to come up with the answer. Next one, is it possible to use a 1031 exchange if I sell property using a title company for escrow while I intend to purchase replacement property at foreclosure auction, where I need to provide purchase funds in cash or cashier's check within 15 minutes of purchase? That's a tough one. So technically, yeah, there's nothing regulatorily that's going to prohibit that. It's going to be logistics. So what happens when you do a 1031 exchange is your exchange accommodator is holding the funds, and they have to send the funds directly to the seller. And so the question is your exchange accommodator going to be set up in such a way that they can wire funds momentarily, and is the auctioneer going to be able to receive them? So that's a tough one. Regulatorily, you're probably okay, but you're going to have to do some work ahead of time to set that up with your exchange accommodator. If I sell a rental property, say for $9 million, of which $3 million is cash and a carryback financing, can I do a 1031 exchange? That it gets a little complicated. You can do it. There's certain things you have to know. Basically, if you have to replace the entire value of the property. And so it can be difficult if you're holding back cash to replace that entire value. If you pull funds from somewhere else to backfill so that you get to the entire replacement amount, you can do that. That's something you're going to want to work out carefully ahead of time with your CPA and your exchange accommodator. Are the rental property costs for 1031 exchange intermediaries between $950 and $1,400? Yes. So the exchange accommodator that you need, which is your secondary escrow account, their costs, I've seen the lowest is maybe $700. The highest is maybe $1,200 or $1,300. My advice here is don't shop for your exchange accommodator based on price. The difference is a few $100s. The difference in experience can be immense. So your exchange accommodator is they're an escrow, right? So they have to be accurate. They have to be knowledgeable. They have to communicate well. They're integral in the transaction. So think about the difference between a time when you worked with a fantastic escrow company and a terrible one. The same difference applies to an exchange accommodator. Your exchange accommodator fee is one of the smallest line items on your transaction. So you want to shop quality, you want to shop experience, you want to shop knowledge and length of time in service. These folks are holding your money. So you want to go with a great company. We work with lots of great companies that we can refer you based on your particular need and your location, but cost should not be your primary concern. It should be, how good of a company is this? Can I buy replacement property first and then sell once I own and still use the 1031 exchange? Yes, but you want to know that going in and work with your exchange accommodator going in. It's not as simple as buying a property and then deciding you're going to sell another property and go in reverse. What you're describing is called a reverse exchange, and your qualified intermediary actually has to purchase the property on your behalf until you sell your first property. So that costs quite a bit more. The fees go from about $1,000 to about $6,000 or $7,000. And you also have multiple transfer taxes. So it can be done, but you need to plan for that ahead of time. You don't just buy the property and then decide you're going to do a reverse exchange.
And you need to have the money available to acquire that property. So if you are relying on the equity in your relinquished property to buy that, that's hard to pull off.
Rick, I assume, are you seeing all the same questions I am in the same order?
No, well, I'm relying on you to go through the questions.
Just thinking maybe we could ping pong back and forth. I'll take the next one. If you can see it, let me know. If not, I'll just keep going. If I convert a vacation home to a rental property, how long do I have to hold it as a rental for the IRS to allow it to be a 1031 exchange? So like a lot of things in the 1031 exchange arena, there is no black and white. The IRS never said hold it for 1 year or 2 years. There's convention, there's sort of industry standard, what's sort of been tested in courts in various circumstances. What the IRS cares about is your intention. So you're allowed to have a rental property and then turn it into a primary residence. You're allowed to have a vacation home and turn it into a rental. You can change the use of a property. And as long as when you sell it, it's a rental property, or when you buy it, it's a rental property, you're probably in good shape. However, the IRS doesn't want you to have a vacation home, turn it into a rental, and then tomorrow say, oh, it's a rental, so I can do a 1031 exchange. They're looking at intent. Most industry, CPAs, qualified intermediaries, will tell you 2 years is very safe. 1 year is medium safe. So it depends on how aggressive you want to be, how aggressive your accountant is. You'll hear, some people swear that 1 year is all you need to do. Some people will tell you 2. What I'll tell you is, regardless of whether it's a year or 2, what you don't want to do is send emails to everybody you've ever met saying, hey, I got this clever plan. I'm going to take my vacation rental, turn it into a rental for a year and a day, and then sell it and get away with it, right? That's going to tell the IRS your intention was to avoid taxes, right? So that's a CPA question, but a year or 2 is sort of the short answer.
And Jason, I would add to that, it depends significantly on whether or not you are going to continue using that property that you had as a vacation home. So if it was a vacation property and then you turned it into an Airbnb and you're still using the property once in a while, that's a totally different scenario. In that case, you're going to rely on the safe harbor rules and convert it to a rental property for 2 years. If, like Jason said, it is your intent to actually rent the property out and to just, under a regular rental for a single family residence, for example, and there's a long-term lease, a year and a day is probably going to be fine. So to answer that question, there's some more details we would need to know. But to Jason's point, it's really all comes down to intent. Are you really holding the property as a rental property, or are you just trying to, do a temporary situation to get around the rules?
Next question is, what is the typical cost for a 1031 exchange intermediary if I don't close on the replacement property? Every intermediary has their own schedule. Some will charge you, 80% of the total fee when the money comes in the account, and the other 20% when it goes out. Some I know have moved toward charging you the entire fee, the $1,000 or whatever it is, to open the account, whether you close on a replacement property or not. So it just depends on what exchange accommodator you're working with and what their fee schedule is. A second question is the same. Is the return from a DST guaranteed per the initial offering? Is there any case that this investment could go broke? So a DST is just a legal form of holding real estate. So all of the economics of real estate apply to DSTs. There is no guarantee of anything. The cash flow that goes out to the investors is based on the rent collected and the expenses paid and having that available. Now, DSTs go a long way to stabilize their cash flows. They start with cash reserves. And typically what they do is if they collect a few $1,000s more rent than they thought they were going to for a month, they don't pay out the extra rent. They stick it in a reserve account. And if in the following month they collected a little bit less rent than what they thought, they don't reduce your cash flow. They pay it out of the reserve account. So they have a stabilization account. That's not a guarantee, but historically what we've seen is investors see remarkably stable cash flows throughout the year. Typically they get adjusted at the end of the year, assuming rents had gone up for the year, and it goes up a little bit. Is there any case that this investment could go broke? Is it a mathematical possibility? Absolutely. This is real estate, especially if you have a loan on the property. If you don't pay the lender, they have this habit of taking the property from you. If we look at the companies that we've done business with that have been in business for as many as 50 years, and we say, did investors lose all their money? Did the properties go broke? No, it has not happened. It's a private market, so we don't know every DST or every partnership that has ever happened, because those are private transactions, and I'm sure some have done poorly. But part of our value to our clients is that we do extraordinary due diligence on the company, their track record, their reputation, their executives, and then we look at the property and the tenants and the leases and all that stuff. So it's possible, but these are structured in such a way that they're designed for clients that want stable income and capital preservation. That's what they're going for.
Jason, I just to add to that, guarantee is a really bad word in the securities industry, so we don't talk about anything being guaranteed. But I will just to add to that, in most DST offerings, there is a contractual obligation by the sponsor of the DST to pay a base rent under a master lease. And oftentimes that base rent is set to be equal or higher than the debt service on the property. So there is a institutional real estate company who is obligating itself to pay a base amount of rent, even when it's a 300 unit apartment community or a 1,500 unit portfolio of self-storage units. So there is comfort in knowing that somebody has taken on a financial obligation to ensure that a minimum amount of revenue is being paid to the DST investors, at least to service the debt that's on the property. Of course, that comes back to the claims paying ability and the economic strength of the sponsor, which, as Jason mentioned, part of our job is to make sure that we are only working with top sponsors that are have the ability to meet their obligations in these situations.
Next question is, I've heard DSTs have heavy fees. Is this true? So if you think about what it's like to invest in a DST, you as the investor are not out scouring the markets looking for properties. You're not putting in offers and negotiating the purchase. You're not arranging the financing. You're not closing the escrow. You're not managing the property. You're not hiring a property manager and managing them. You're not doing any of the accounting. You have no legal liability if there's a lawsuit or anything like that. When the property is sold, you're not going through that whole hoopla of hiring a broker or an agent and putting it on the market and paying the cost to market the property nationally. You're not doing any of those things. And so there's an army of people that are doing those things for you, and they all get paid, including our firm. As advisors, we help put clients together with appropriate Delaware statutory trust investments. So yes, the fees are high, but they're also misunderstood. And the reason I say that is in real estate, usually if somebody's talking about a brokerage commission of 5% or 6% or whatever the number is, that's off the total value of the real estate. Well, on $1 million transaction, they might have $300,000 of equity, but it's a $1 million purchase price. So 5% of that is $50,000. Well, that's off the total purchase price. Well, $50,000 is a very significant portion of your $300,000 of equity, but people don't think of it that way. They think of it in terms of the total real estate. In our world, some of the fees are based off the equity, some are based off the real estate, some are based off the cash flow, some is based off the loan amount. When you wrap all those together, you're typically looking at about a 7% markup, something like that. The fees are ballpark 7% higher than the value of the real estate being purchased. Now, some people are going to look at that and say, well, that's too high. I'm going to go do it myself. And I don't disagree with those people. If they want to go find the property and arrange the financing and be a signer on the loan and go through all of that to save some percentage points, then they should do that. But for other people, they look at it and they say, I can avoid all of that work, all of that stress, all the time clocks. I'm not a party to the loan. and I'm still making 4 or 5% cash flow, positive cash flow, then that can be a deal. So are the fees higher than if you went out and bought it yourself? Absolutely, but you're getting a lot for that. So you have to determine if it's worth it given your situation.
Jason, there's a chat question in the other. So we've been getting most of these through Q&A, but there's a chat question I wanted to answer. And this comes from Irene. She's got a couple of them actually. Irene's first question is, if you sell a property for 800 and then you buy a property for 725, you've got 75 left over. Can she buy a mobile home with that $75,000? And I have a better idea of what to do with that $75,000 in that situation. And so I thought maybe you could talk to what that other idea would be other than going and getting a mobile home.
Well, first, yeah, you can. If you want to go buy a mobile home, then you can certainly do that and be part of the transaction. The other thing that you can do, of course, is invest that amount into a DST. The minimum investment amount for most DSTs is $100,000, but the companies are usually pretty flexible. They don't want to make somebody pay taxes because they have $75,000 or $80,000 and didn't meet that $100,000 mark. So, like I say, the typical cash flow right now is 4 to 5% cash on cash. So that's $75,000 in a DST would be making 4 or 5 plus whatever the appreciation is. But to answer the question, yes, you could go into a mobile home if you could find one at the right price. Of course, you're gonna have to pay the lease rent on top of the purchase price. But yeah, you could.
Irene's other question is, what about Prop 13? If I have it and a new property has it, is this transferring? And so this is a California question for our non-California folks, but like I said, we are in the business of helping people sell their West Coast properties and typically reinvest in markets like Texas and Florida and Tennessee and Colorado and Arizona. And so, you will be subject to a new property tax regime if you sell a property and do an exchange out of California, out of state, and so you don't see that property tax, obviously, but that's being, that's one of the many expenses built into any of the DST properties. But there is no way to hold on to your Prop 13 tax rate once you sell a property and reinvest in outside of California.
Next question is, how long will DST last before any changes take place by the management? It's kind of a broad question. I'm not exactly sure what you're getting at there. The nature of DSTs is that there's not a whole lot of changes. The IRS requires that when you buy when a DST buys a property and they put whatever financing they put on it and manager and all that those things don't change. So if you invest in a DST, the property that you evaluated to invest in that DST is the only property that's going to be in it. The financing is not going to change. The property manager is not going to change. It's designed to stay the same until ultimately the property is sold. Can you withdraw from a DST and move back into individually owned real estate investment? Yes. So that's one of the great benefits of a DST is you can sell a single family property, do a 1031 exchange into a DST, and then when that DST sells, maybe it's 5, 6, 7 years down the road, you can do a 1031 exchange back into a single family residence or a piece of land or a condo or whatever you want. It's considered real estate. So you can 1031 exchange into it and you can 1031 exchange out of it. Can you recommend how I can learn more about DSTs to the point where I can make investments? So that's our mission in life, is to make that bridge for you. So you could start by going to our website, which is 1031capitalsolutions.com. At the top, there's a Learn tab, and that is where you'll find a tremendous amount of resources. There's a DST investor checklist. There are all of the concepts that you want to understand. There's brochures, we have videos, we have articles. We have a regular webinar that we did that's dedicated to DSTs. We're sort of talking about them after the fact, but we've got a 45-minute webinar that goes through the benefits, the risks, the limitations, all the questions that come up, the different structures. Our hope is that by reading our book, watching our videos, reading our brochures, and then using us as a resource. So you read the book and you come up with 5 or 6 questions. You schedule a call with us and we go through those questions with you. You read the brochure, it sparks another couple questions. You give us a call and we go through those. We know that nobody's going to invest in a DST unless they are comfortable with it and they've made a decision that it's in their best interest and it's what they want to do. So our whole mission is to provide the education so that you can make that determination for yourself. And frankly, some people will go through the entire process and come out the other side and say, you know what, DST is just not for me. I don't have enough control, or the fees are too high, or I can't do development, or for some reason or another, this isn't right for me. And that's just fine. We don't want to persuade anybody to do something that's not right for them. However, there's a lot of people that go through that process and discover that this is an absolute heaven sent that they didn't know about. They can sell their property, defer all the taxes, get, in most cases, more cash flow, and get appreciation and not have to manage the property. So it starts with going to our website. You can reach us through the website for follow-ups and additional information.
Jason, I went ahead and re-shared my screen so people can see the site. And on our homepage here, you can see you have another opportunity to order our book. We've got a video to learn more about us. We've got access to recently closed offerings, and then as well as a whole learning center. There's a couple ways to get to that learning center. I'll click here to show everybody what we have as our learn page, and articles and videos, DST basics brochure, a DST investors checklist, information on our process and one-on-one debt. There's information about our real estate investment analysis report, and then glossaries and guides to all of this information. And by the way, almost every single question that's been asked today, there's an answer to that question in our book. So it really is a great resource on everything DST, everything 1031, everything investment analysis. It is a comprehensive book to help people make a decision to hold, buy, or to exchange their rental real estate. And you can click on this link here on this page and just immediately download a digital version of that book. So a lot of great resources in addition to the ongoing events that Jason mentioned. We have typically at least one, if not 2 webinars every week on multiple topics related to what we've been talking about today. So if you stay engaged with us, I promise you, we will help you make very educated decisions regarding your rental property and doing an exchange.
Rick, we're right at 12:30 almost, and I'm out of time here. We didn't get to all the questions. It seems like for every one question we asked, 2 more were added. So we're gonna have to follow up with people and get back to them and answer these, which we will certainly do. There's some good questions here. I think I have to wrap it for today.
Okay. Well, thank you so much for taking so much of your time. I really appreciate it. I think the people on the call will as well. And for those of you still left on the call, I will be emailing you the recording tomorrow, as well as all of the information. I hope you enjoyed it. And until next time, Rick and Jason, I look forward to seeing you.
Look forward to seeing you. Thank you so much. Thanks, everybody.
And we'll get back to everybody with the answers to these remaining questions.
Thank you so much. Take care.
Bye-bye.